Hi, everybody. Thanks for watching our video. My name is George Light.
And I'm Trisha Ghosh.
We're mortgage lenders here in Austin, Texas. A lot of our realtors, a lot of our clients, they're asking us, hey, where are mortgage rates headed in 2025? So we wanted to jump in here and give you a quick video. For you to really understand where they're headed, we wanted to give you a quick history of where they've been. They've been at historic lows. And everyone's wondering, is it ever going to get back to that? So we wanted to give you some insight on that. So, Trisha, what's driving interest rates right now?
Yeah, so a lot of different things drive interest rates. It's not just one thing that, oh, here's now what rates are going to be. But the majority of that is different, the US economy, right? And monetary policy, inflation. Inflation's a big driver of rates. The Fed rate, the Federal Open Market Committee, they are targeting inflation of 2%. And so they adjust the Fed rate up and down. And there's two different kinds of interest rates. So there's the Fed rate that you hear about all the time that they only change it maybe once a month, sometimes a lot longer. There was a long time where it wasn't changed at all. And then now more recently it's been fluctuating. That's different than mortgage interest rates. And so you have to kind of keep in mind that those are two different things and they're not directly correlated. One does not directly influence the other, but the Fed rate does kind of indirectly um, move mortgage-backed securities and mortgage rates. So
When we talk about inflation, inflation is really just the cost of things year over year. So right now we're about 3%. So something cost $10 last year, they cost $13 this year. And so that's really what inflation is. And the feds try to control that so things aren't so expensive because people can start buying these, brings our economy to a halt. So the feds use the Fed's fund rate, and that really raises what, Trisha? When the Feds affect that, what kind of interest rates does the Fed do the Feds impact?
that's just the overnight the rate between banks, basically, when they're trading money overnight, that's the rate that the Fed sets. And
So
so,
credit cards,
yeah.
auto loans, home equity lines of credit.
Mhm.
So what we want to talk about next is, well, that's that set of interest rates. The one you're talking about, Trisha, is mortgage interest rate and long-term interest rates.
Right.
So just a quick history. Mortgage rates generally follow what they call the 10-year treasury yield or the bonds. And when those yields go up, mortgage rates will rise. When they go down, they fall. There's a whole class that we could spend hours talking about bonds, which will put me to sleep. And I'm supposed to be someone that even knows it. So basically, bond yield is a return an investor expects to receive. So really, you have two different types of things that investors will put their money in. They'll do when stocks are improving, the economy is humming. A lot of investors will put their money in the stocks, and that will cause interest rates to go up and because they'll
Hmm.
provide a big yield. When stocks do poorly, a lot of people will flood to the bond market, and because there's so many buyers, the yield will go down. Hence, interest rates.
Right. Yeah. Me as an investor, if I have this pool of money that I'm going to put into the market, am I going to put it into the stock market that is doing poorly right now? Or am I going to put it into mortgage-backed securities or other bonds that have a guaranteed amount of how much I'm going to get out? And I know what that is. So the more people go into that, the lower the interest rate gets because those are more popular, supply and demand, all that kind of stuff. So,
So typically, you just have investors, but what happened in 2008? Well, we had what they call some people call a financial crisis, mortgage caused by mortgage-backed securities. There were rating agencies that were saying, "Hey, these mortgage-backed securities are great and they're going to be performing great," but really they weren't. So they were toxic and it would cause a whole meltdown. And really, the deck of cards started to fall. So the feds entered and said, hey, we're going to buy trillions of dollars of mortgage backed securities. So we had investors that were playing bonds and stocks, but now we had the feds who were now purchasing trillions of billions of dollars a month, really,
yeah.
in mortgage backed securities. And so at some points in time, we would have very low interest rates and the market would be doing well. And so you'd have people making money in the stock market. And, that, but the point was the feds wanted to stimulate the economy
Mhm.
and stimulate the housing market, which in turn does what, Trisha? You have buyers and sellers. You're selling real estate, but what else have you got that's motivated?
I mean, it's the whole real estate industry. It's home buyer, home builders, the whole construction trades, everything like that. So I mean, stimulating home buying does affect a giant portion of the economy. And
Right.
what quantitative easement did in 2008, it just with the federal government entering into this market, it didn't make normal like supply and demand of this is how a normal market behaves. And that's how it's been over the last 15 years. I mean, really for
And
since '08 to 2022, the feds had
that's when the
trillions of dollars that
yep.
they were had purchased in mortgage-backed securities, which
Mhm.
was not a normal market. That does not, it wouldn't allow the market to behave normally. So now
So
that the feds have gotten away from quantitative easement and no longer have that $2.5 trillion in mortgage-backed securities, we've now entered into a normal market where things can actually adjust based on those investors and where they're going to put their money and how the market is doing in other places. So it just has returned to a normal market, which is why we have seen interest rates increase since 2022. And in 2022, that's why they increased so much.
right.
So,
So what so the feds have exited buying mortgage-backed securities. So we also had a twofer when the feds decided to exit the bond market and buy mortgage-backed securities. They also started raising the Fed fund rates
yeah.
to quell inflation. So those two don't necessarily the two happen at the same time. And so we'll show you on these graphs coming up. Really, what I would do is on the following slides is show you kind of a visual aid of what we're talking about. The first one being how long-term interest rates and the 10-year treasury yield impact each other. And you can see, obviously,
Mhm.
Trisha.
Yeah, so and mortgage rates are long-term interest rates. So you typically get a mortgage for 30 years. So that's why we consider that a long-term rate versus the 10-year treasury yield is they will make this much money over 10 years. But there's a pretty tight correlation there. There you can see that the mortgage rates in this top graph is the mortgage rates since 1971, and then the bottom graph is that 10-year treasury yield, and it follows each other. So if you were to put a trend line on this graph, which is just mortgage interest rates since 1971, the average rate here would be 8.25%. And right now we're probably in the low sevens for interest rates. So we're still below the average over the last 50 plus years. And so it's a 7% rate isn't a bad rate. And this is what people have to wrap their head around because for the last 15 years, we've been in this quantitative easement that has not been a normal market. The Fed's buying all those mortgage-backed securities had not allowed it to behave normally and had artificially held interest rates down to record low rates that it's just now that we're not, they don't have those trillions of dollars in mortgage-backed securities. So now we're in a normal market. This is the way
Yeah.
the market's supposed to behave.
When you look at take out from about 2008 right here over to
Hmm.
now. So obviously this big spike here, that's when the Fed stopped buying the mortgage-backed securities and it caused those levels to rise. But look outside of this. Look
Yeah.
outside of from 2008 to now. Like you said, there's, really it's 8.25%. So when you take that into consideration, and of course you have over here where interest rates went all the way up to 18%.
Right.
No one really thinks they're going to go that high. So really what we want to focus on is those times around that in between our lows and
Hmm.
highs. Like you said, 8.25, right? So 7% when you're talking about 8.25 looks pretty good. And we feel like you said, things are just resorted back to normal. So, we said all of that to say, yields have been fluctuating recently due to mixed signals of the economy. So When the feds are talking about raising the Fed fund rate, they'll also talk about the US economy, which has that indirect correlation on the 10-year treasury yield. But the Fed funds rates, they've a lot of them expected to drop them a lot lower, and a lot of that's happening, which is indirectly impacting rates. But really, interest rates have been holding a little steady, like you talked about, around 7%. So a lot of things to be looking at. There's instability in the global markets.
Mhm.
That can push treasury yields lower and help stabilize mortgage rates. Same time, global inflation rises and other central bank raises rates. It can put upward pressure on the rates. Right now, we've been holding steady around 7%. So what does that really do, Tricia?
Yeah, so that helps people wrap their heads around that 7% is not a bad rate. I've had conversations with buyers that are like, well, but it's not like I need to wait until it goes down. Well, it may not go down. It may go up. And
Yep.
there's the millennials are the largest group of people in the US, and that age group is who's buying homes, especially first-time home buyers. And so there's this huge group of people that have to adjust their expectations and realize that a 7% rate is not bad and that we're never getting back down into the threes. Like that was a very odd situation and a fluke in the market that was artificially done, and we're not going back to the threes. I feel very confident saying that in my lifetime, I will never see a 3% mortgage 30-year interest rate again. So we just have to
A
get
lot of
used to
people. Yeah, yeah, sorry. A lot of people, they initially came out this year, economists were saying they may get down to the six. A lot of
it.
them come back and said that no, probably best case scenario, we're going to be 6.5% range on your 30-year fixed rate mortgages. So, we're here at seven,
Yeah.
we're thinking probably 6.5, maybe best case. So I think what we want to do next is talk, should I wait, time the market right? And really, what is the difference? What does it mean to me? What does it mean to me, 7% versus 6.5%?
Hmm.
So that's what we're going to talk about in our next video. So thanks for sticking around with us.
Yeah.
We'll be right back.
Okay. Thanks, guys.